My name is Dan Friend, and I'm a loan officer with Supreme Lending. Just to give you an idea, I've been being a loan officer in the retail side since 1990, so I've been around the stream a little bit. Today we want to talk about what does it take to purchase a new home, and I'd like to go into a number of details on what it does take to do a new home. Sorry that I've got to sit. A little over 3 weeks ago I had both knees replaced, and so my stamina for standing up is very limited at the moment. Now if this were 2 months from now, it'd probably be a different story, but today I need to do it, is sit. But feel free to come on in and sit down. What I'd like to do is we go through there's 4 or 5 topics that I think are critical for us to discuss today, and as we're going through those topics, feel free to ask the questions as you think of them instead of taking them at the very end, because sometimes we forget what our questions are at the very end. But also, don't be bashful on asking questions, because there's often, if you've got a question, there's often at least 1 or 2 other people in the same room that's got that same thing in their mind and concerned about what to do. Obviously, you're here with Grand Prairie Down Payment Assistance, or that's one of the primary things that is here at this seminar today. And I want to let you know that we can add a down payment assistance program to any one of the mortgage programs that exist out there. There is the Grand Prairie, if you're buying inside of Grand Prairie, as far as the down payment assistance program. But there are other programs if you're specifically buying in Arlington or Fort Worth or Dallas. There's specific programs there. But actually you'll see a booth out here by TSHAC, and TSHAC is one of the state programs, and there's 4 or 5 separate state programs that allow us to add down payment assistance to any home inside the state of Texas. Now, be aware that there's certain criteria that we've got to deal with for each one of the down payment assistance programs, but I want to let you know that they're available, and they're not only available just in Grand Prairie, but they're available statewide. And our office and Supreme Lending, and really most any lender that's aware of down payment assistance, can certainly help you guide you through those programs. Sometimes, like yesterday, I had a realtor call me, and the client definitely wants to use down payment assistance. They want to buy in Arlington, and Arlington offers $75,000 or $7,500, excuse me. But yet, when I add a state program to her program, I can actually get her $10,000 through a state program. So, and it's all based on the price of the home. It's 4% or 5% of the price of the home. So sometimes what people first ask me is not always the best, if you know what I'm trying to say. And we have to just sift through what the best is, and that's really what my job is to help you. My ultimate goal is to help you purchase a new home. That's what I've been doing since 1990. I have no other goal than that along the way. Now, just to give you an idea, you've heard of different loan programs out there. There's FHA, there's conventional, there's VA, and there's USDA. All have their uniquenesses to it. Like FHA, it's the least amount of money out of pocket. It's 3.5% down. Conventional is 5% down. USDA is a unique product if you're buying a home outside the Metroplex, meaning if you're buying in Red Oak, you're buying in the east side of Forney, if you're buying in probably Cleburne or Joshua, Venus down to the south, and if you're buying on the west side of Denton, or the west side of the airport if you're going up to Denton. It's called, USDA is Rural America, but it's 100% financing. It's a very good program that you can meet into, and again, we can add down payment assistance to it. But again, it's a very strict program, so you have to meet the guidelines very carefully. Then there's VA, which is if anybody is a veteran, we can obviously offer you a VA loan, which is 100% financing. And again, if you do want down payment assistance, we can add to that. So no matter how you come to me or come to any loan officer, you can certainly, there's a lot of loan product out there to help you purchase a home. You're not always stuck in one category. And sometimes people only sell one product for some reason. Like a lot of people only do FHA. It's easy, and if you meet the guidelines. So anyhow, just to let you know, there's at least 4 different products out there. We can add down payment assistance to all of them. Now, the requirements to get a loan. There's 3 basic pieces to getting a loan. You've got to have credit, and each one of the loan programs has a different criteria for credit. Then there's the second piece of that. You've got to have income. You have to have a stable income, and we have to prove up that stable income. And your income becomes one of the biggest limiting factors for how much home that you can purchase. And then there's credit, your debts. We have to look at your debts, and we have to look at your credit score. Now, I think credit scores have become much more important to people in the last few years. There was a good period of time where people just didn't pay attention to credit scores, and there was a time when we didn't consider credit scores at all. It didn't even exist, when I first started in this business. But credit scores right now are really, really critical. They're the gateway to opening up any loan. For instance, we can offer a FHA loan at 580 middle credit score. That means we pull a credit report from all 3 credit bureaus, and the middle score has to be at least 580. Now, at 580, your interest rate's probably going to be in that 5.25, 5.5 range. So it's going to be a high interest rate, but it's all predicated on credit, and that's not Supreme Lending setting up that interest rate. That's not any other lender. That's Fannie and Freddie. That's the national program setting it up. It's not us. But if you give you a difference, if you had 620 credit scores, 40 points higher, you would be able to, we'd be able to offer you the same FHA loan, but at more like 4.5% interest rate. So you can see a huge difference in what credit scores can do for you. The other side is at 580, we have to keep your back ratio at like 43%, which is extremely limiting factor. When I talk about back ratio, which is, I'm sure, foreign language to you folks, is we take what your new house payment was going to be, and that's with taxes and insurance and PMI. So your total monthly house payment, plus what your current debts are, like car payment, charge cards, child support, and any other regular debts that are showing up that we have to keep that number against your gross income at 43%. But the difference is if you get to 620, not only the interest rate gets lower, but instead of being at 43%, I can expand your back ratio to 55%, which is a huge difference in the amount of house that you can actually purchase. So not to overemphasize credit scores, but it is a real important thing. Now, there's a lot of people that say, well, we need to go to credit repair, we need to do this, we need to do that. I've done credit repair for people for years and years and years, and I don't charge for credit repair. And the reason, I have only one goal in mind. My goal is to help you buy a new home. But if I can look at your credit report, I can make some suggestions, and often within 60, 90 days, we can take a 580 credit score and get it to 620, which improves your whole situation. But I'm not going to do the work. I'm going to coach you on whatever the work is that needs to be done, and then you'll have to negotiate and pay off the collections or pay down the debt or whatever we suggest. Sometimes it's opening up a new account. Sometimes there's a number of things that could do it. But the object is to help you ultimately get your credit score in a way so about 10 days before closing, we have the credit score where we want to be so we can lock the rate and offer the interest rate that you'd like to have, and be able to underwrite you and get you approved for the house that you'd like to buy. So there's there's a lot of different pieces and parts to this. I've come to the conclusion that it's really better for us to make sure we've got your credit score about where it needs to be before you actually start shopping for a house. But that's a hard thing in today's market, because many times you're going to go and make offers on a house, and you may be making 3, 4, 5 offers prior to the time that you actually get an accepted offer. So I tell people right now, buying a home is you've got to have a little thick skin, because your dream home that you drive by and you see the first time that your realtor takes you out to look at something, the likelihood of you getting that contract is probably 1 out of 100. Hate to say it that way. But there is the right house out there for you, and there is the right house at the right time with the right price. It's just being tenacious, honestly. It's just being tenacious. And I'm not trying to make light of that, but I'd like you to understand that that's a piece of the puzzle right now. Sellers, it is a seller's market. There's very little seller concessions going on. So I caution people on saying, because I have people saying, well, they want $150,000 for that house. Well, I'm going to offer them $140,000 and they pay all the closing costs. Well, you just wrote the biggest joke in the world. They're going to laugh at you right down the street. It just isn't going to happen. If you go in there and offer them $150,000 and they pay no closing costs except title and survey, you got a 50-50 chance of making that deal work. But if you think somebody's going to step up and pay all your clothes and this and that, just not today. Yes, in my history of being in the mortgage business, that was true. I won't deny that. Back when we could get deals written that were unbelievable. But at that point in time, it was a buyer's market. Huge difference, huge difference. And I would say for at least the last 5 or 6 years, it's been a seller's market versus being a buyer's market. And that's not to dissuade you from buying a house. I think home ownership, the reason I'm in this industry, I believe home ownership is a fundamental piece of keeping our community strong and alive and vibrant, because people put roots down. They have ownership in that property. You're going to make sure that school district runs right. You're going to make sure that the neighborhood is clean and taken care of. You've got something that's yours and tangible. I know I've owned a house in Arlington for many, many years, and you know, you have pride of ownership, just huge pride of ownership. So again, I'm willing to take questions as we're going along. So does anybody have any questions at the moment? Go ahead. The lady in the red, please.
Yes. What do you predict as the, how should I say, how long do you predict that this market will stay as it is in terms of the seller's market?
I would say almost forever. Yeah. If you think it's going to flip and it's going to turn your way, number one, a year ago when I did this seminar, going rates were 4 to 4 1/4. Today they're 4 1/4 to 4 1/2. So the interest rates are increasing, but I don't see this changing from a buyer's market to a seller's market anytime soon. It's supply and demand. Good quality homes out here are moving very quickly. Junk homes, they're there forever, okay? And then the remodelers, the guys that are flipping homes, sorry to expand your question a little bit, are doing a great job in remodeling the homes, but they're asking premium prices for those homes at the time. We had to walk away from a deal. A lady that I met actually a year ago here at this seminar, really sweet lady, she got her eye on this house that was being remodeled here in Grand Prairie. And it's in a $140,000 to $150,000 marketplace. And I found out what the seller bought it for, and I figured he would sell it for that $150,000, $160,000. When we got the actual contract from him, it was $175,000, which took it out of her ability to qualify for that loan. And we tried to negotiate with him and blah, blah, blah. No way he was going to do that. So it's a tough market. It's a tough market. You just got to be careful. That's all. But don't be discouraged. That's what I'm trying to say to you. Don't get down. Yes, sir. Sorry.
What would you say your best advice would be as far as trying to win bids? That's been my biggest problem.
I'm sorry.
Trying to win bids, or like when you're going to bid on a house.
Yes, yes.
Other people bidding on it. What would be the best approach to get
Well,
that bid to go?
yeah, honestly, the realtor will give you probably better advice because they're going to know the neighborhood just a little bit more. But the truth of the matter is, if you got multiple bids, I mean, I had one the other day, had 10 bids within the first 2 days come on that house. And the person that got it paid $10,000 more than the asking price with no closing costs, and they didn't pay, and the seller didn't pay title or survey, which is just unbelievable. And my concern on something like that is that really credible? Because will the house really appraise for it? You know, that's the other side.
If it doesn't, then we have to come out of pocket when it doesn't appraise for, right?
You have the option. If you wrote a contract and now it doesn't appraise, let's say you wrote a contract for $200,000 and the house only appraised for $190,000, okay? At that point in time, that contract becomes renegotiable, and you and the seller work out a working agreement. But yes, you're right. If you would have to, because we as lenders will only loan on which is lower of the two numbers. In other words, if the appraisal is lower than the contract, we lend on the appraisal value. So you're right, you would have to bring the difference to the table. But often what happens in a deal like that is buyer and seller are able to negotiate, and maybe they come down to 193 or 4. Maybe we can talk to the appraiser, and maybe he can come up a little bit. I mean, there's a lot of give and take in there, so it's not a hard fact. It often takes us about a week to kind of get that contract renegotiated, or see if it's even can be renegotiated is probably the best way to say it. But the answer to your question is just what you're saying. You would have to bring the difference. But go ahead.
Okay, so you were talking about down payment assistance earlier, and how the state can give us down payment assistance. And does the seller usually pay closing costs, or is that expected for us as the buyer to pay those?
No, you pay your own closing costs. The seller is not paying any closing costs.
How much on average does it put?
Okay, if you take an FHA deal, this is just working numbers, okay? And I'll give you 3 different working numbers so that you can help out. That'll help you as you're just driving down the street and answering your questions. FHA is 3.5% down. That has to be your own money or gifts from family, okay? So can come from gifts from family, or it has to be your own money. That's 3.5%. So if you're buying a $200,000 house, that's $7,000. It's got to be your own money. The second piece to the cash to close is your escrows and your prepaids. Those in combination run about 3.5%. So that's about another $7,000. That's where down payment assistance, $7,000 to $8,000. That's where down payment assistance can help you in one of two things. Fortunately, down payment assistance can help you with down payment also, or it can help you with closing costs, whichever is there. But you're going to need between 7 and 8% of the sales price of the house to close. So if it's $200,000 gross, you need $16,000 to close. Can 4% of that, $8,000, possibly come from down payment assistance? Yes, it can. Now, the other money is going to have to come from either the seller paying something, which in this market's very hard, to you having the money or being able to get gifts. The third number I'd like to give to you is if you're just driving down the street and you see a for sale sign and they've got a flyer in the thing and it says this is a $200,000 house, what's the first question you've got? What's my payment going to be? Okay. Take 0.9 times that sales price, which would be $1,800. And that's going to be plus or minus about $50, $60 from your payment, depending on the taxes on the property and your homeowner's insurance. Sometimes it's lower because it's got a lower tax base on it. Maybe it hadn't been evaluated in some time. But if you're just driving down the road, just use 0.85 to 0.9 and look at it, and you'll have a pretty good working sales price just to know, is that house in my price range? And really, prior to going looking at a house, the worst thing somebody can do is go look at a house, fall in love with it, and you don't qualify for that house for a bucket of beans. You know, and that's the emotional roller coaster you don't need to go through. That's not derogatory. I mean, my wife does it all the time. So I think that's just human nature, if you know what I'm saying. That has nothing to do with any individual. Our eyes are always bigger, or we'd like to have, but anyhow, those are some working numbers that might help you just a bit. Any other questions? Well, yes, right behind you. Ma'am? Right. I'm sorry, say it again.
What is the percentage that they multiply times the sale price to get the estimated mortgage payment that they would do?
Okay, 0.9, okay, 1% of 200,000 would be 2%, $2,000. Okay, 1% of 200,000 would be $2,000 a month. If I'm using 0.9 or 9/10 of that, that would be $1,800. Does that make sense? Okay, please, I don't want to confuse you. What I really am trying to do here today is just simply make the buying home experience more pleasurable and easy. Okay, it's not complicated. This isn't rocket science, if you know what I mean. But there's a lot of things that you can do to answer your own questions as you're driving up and down the street, or you're shopping, or you're talking to a realtor, you know, about things. But I gave a lot of cards out. I've got cards up here too. You're free to call me anytime. My cell phone number is on my cards, and I answer that phone 7 days a week. So there is a question over here.
Yes, on that 0.9%, does that include your taxes and insurance?
Yes, sir. Yes, sir. That's a total payment. Now, again, it's not a perfect science, please. In no way is it to be a perfect science, but it's to at least give you confidence that this home is in your price range. But it does include principal and interest, taxes, insurance, and PMI.
What do you think about for us to start considering HUD homes? And if that is a consideration you would think of, what are some of the hiccups that you come in contact?
Okay, that's a great question, because HUD homes have been out there for years and years, and HUD homes often are sold below the market value of that home. Now let's back up for just a minute and give you the definition of what a HUD home is. A HUD home is an FHA foreclosure that HUD has taken back in because it's foreclosure. All right. Now, if a home goes to foreclosure, let's think this through just for a second. And the family that was living there, they've been struggling for a year or two financially before it went to foreclosure. So at least for a year or two, there's been no maintenance done to that house because they didn't have the money to do any maintenance on that house. And HUD is often selling the homes as is. They don't go in and rehab the homes, or rarely do they go in and rehab the homes, you know, prior to you buying them. So it's shopping through the HUD homes to see which one is a good quality home. Now, I have seen HUD homes go as much as 30% above what HUD is asking for because it's a really good quality home. They're asking 120 for it. I've seen that go for 150, 160, 170. Not saying it won't appraise for that, but you got to realize that again, you're in competition with an awful lot of good buyers coming at good properties. Good buyers, good properties brings a lot of attraction to that property and a lot of offers to that property. Nothing wrong with a HUD home. Have done them for years and years and years. You need a little thicker skin when you're dealing with a HUD home to be able to see and understand that there is deferred maintenance in that property, and you're probably going to have to go in and paint the walls. You know, there could be a lot of things you've got to do, but honestly, when my wife and I bought our house many, many, many years ago, we looked and looked and looked, Fan, I was so frustrated on trying to buy a house. I wasn't in the mortgage business at that time at all. I was a traveling salesman. So I only came home on the weekends to look at homes, and my wife and the realtor would go out during the week. And I bet you we'd looked at 30 or 40, maybe even more than that, homes over the last 3, 4, 5 months that we were looking. And we were renting in Arlington and just wanted to buy. And we walked into this one house, the house we bought, and the realtor said, "Now, I don't know that you're going to like this house, blah, blah, blah. 2 college boys have been living in this house. Their parents have moved to Mount Pleasant, and they've been here about a year and a half. They're going to UTA, da-da-da-da-da-da." Well, I'll tell you, we walked in that house. It was one wreck. That's all I got to say about it. These guys were hunters and fishermen, and you could smell the grease and there were horns all over the thing. There were fish mounted all over the house. There were skins on the roof. There was a old bathtub in the backyard that needed to be thrown away. I could go on, and I didn't think my garage had a concrete floor till I pushed away about 2 inches of dirt. I mean, that's how, called deferred maintenance, huge. But it was the perfect layout for our family. And structurally, it was great. And the guy was selling it for a very, very, very good price with very, very good terms. My wife and I just looked at each other and said, "We don't care. We plan to come in and paint the walls and put new flooring in and do some things to the bathrooms and kitchen. Anyhow, no matter what house we did, we'd kind of had that in our little budget to do these things anyhow." We made an offer and we bought that house. But it's, again, you've got to be able to see through how are you going to live that house, what's it going to take to get your family comfortable in that house, and then have the disposable income to do what you got to do. So everybody's different. That's all I got to say. Everybody's different. Wish I had a magic wand, but man, I don't. So to give it to you. Okay. Any other? Yeah. Oh, there's one back there.
About the HUD homes, do they automatically, can they qualify for an FHA loan, or because they're sold as is, would it have to be under a conventional loan?
Oh, no. They're available for any financing that's out there. HUD is simply the seller of that property. They are not dictating. Now, sometimes there's some reasons that HUD will say this can only go conventional. And conventional will wink at some repair items that FHA will not wink at. And there are some HUD homes that are pretty, need a lot of repair to them. So if it says HUD and conventional only, that is the first red flag to realize that there's probably a great deal of repairs that need to be done to that home, and to really dig in and see. Now, if they're just cosmetic, that's not a big deal at all. And I flipped them from conventional to FHA often, even though it's a HUD home. But you got to dig into it a little bit farther. Home buying is, to me, there's a bunch of things that you need to do in home buying. First, you need to figure out what your price range is and what part of a city that you want to live in. And then in that portion of the city, what are the 2 or 3 neighborhoods in that quadrant of the city that you really think this is where I want to be because of school district, because of closeness to work, just numbers of things. And then if you will be tenacious and drive that area or work with a realtor in that area, you'll find a deal, but you'll also become the most savvy buyer inside of that neighborhood. So when you go to put an offer in, you know what a good offer is going to be and what a terrible offer is going to be. And if somebody's coming in and this is a $150,000 neighborhood, and you know that the max is $150,000, and they're coming in at $160,000, $170,000, just laugh them off, because the deal's going to fall apart. It's just not going to work. Just like the appraisal won't come in. So guess what? A month later, the deal falls apart. You reoffer it, and you'll probably get the deal. I've had that happen more than once, to people. So it's the most educated you can be about what city you want to be into, what part of that city you want to be into, and what neighborhoods you want to be into that thing. You will win a bid much, much easier because you really know how to make that offer right. Okay. And a lot of people just throw a dart against the wall, and today they're in North Grand Prairie, tomorrow they're in South Arlington, third day they're over in someplace in Dallas, and wrong. I mean, you'll never successfully, and you're not going to be happy. 2 years from now, you're going to be selling a house because you weren't happy in that neighborhood anyhow, because you really hadn't done your homework in it. So, okay, any other questions that we got? Okay, some of the basic documentation that we're going to need, and the difference between a W-2 wage person working by the hour or a self-employed person, but some of the basic information we're going to need is 30 days worth of pay stubs if you're a W-2 wage person. We're going to need 2 years tax returns. We're going to need 2 years W-2s. We're going to need 2 months bank statements, copy of driver's license, social security card. And that allows me to pull a credit report and just evaluate what your credit is against what your debts are and what your income is. And the reason we asked to get the tax returns is the fact that right now there's ways of getting around this, but we've got to be very, very careful. Is some people, in fact, I looked at one yesterday, and it just boggles my mind. This person, I forgot what business he was in, but he wrote off $33,000 in 2016. He wrote off $25,000 in 2015 as a self-employed Schedule C person. But whatever business he was in, he had no income for that business in either 16 or 15. He also made about $80,000 in a W-2 job. So he hourly or salary, he was being paid very nicely. But yet he was writing off 30, 40, 50% of his income on as a self-employed person. Well, we have to take that loss against his income. So, and he wanted to buy a $250,000 house. Well, he could qualify for $80,000 house. And he didn't get it, but I'm sitting there going, wait a minute, you write all of this off, you say you have a business, but every business that I've ever been in, that I've been self-employed in or Schedule C'd in my tax return, it had some revenue stream. Why are you in business unless you take revenue in? You know, if you're only in business to write off your taxes and reduce your tax liability with Uncle Sam, it's not likely that you're going to be able to get a loan. Now, there is an option that we call W-2 waged only. In his case, I couldn't use the W-2 waged only, meaning we don't use his tax returns only, we just use his W-2s to support his income. But he owns rental property, and the rental property is on his credit report, and when we have to support whether he's making or losing money on his rental property, we have to have his tax returns to do that. So we would have to expose to the underwriter the fact that there is, that there is this loss going on no matter what. And I don't know how he's going to handle that, but it just is a thing. Okay, question in the back.
Okay, in terms of people who probably don't have a long credit history or no credit, what do you recommend for them, but they do have a good solid income? And I'm more specifically talking about kids that are coming out of college and they just started a new job.
Okay, if you're coming out of college or you're coming out of school in any way, for work history, we can use the work, but for credit, they've got to establish their own credit to some degree. And what I tell people in that case is get added onto a mom and dad, three mom and dad charge cards, because you're going to carry through the instant credit history that comes from mom and dad, but also open up your own charge card, 1 or 2, put tank of gas on it, pay it off, put tank gas on it, pay it off. You got to begin to reestablish your own credit. And that's a perfect example where that person may have mom and dad co-sign on the first loan that they do. But we've got to have at least one credit score from each borrower to make it work, co-borrower, to make it work. So there's ways to work with that. Often that's a perfect client that when you first see them, they're not qualified day one, but they could easily be qualified 3-4 months down the road. you know, to do the deal. So.
I had a question from someone over here was too shy to ask, but what if there's credit repair that needs to be carried to the credit? How do they go about that?
Okay, again, I'm happy to coach people through, let me use that word twice, coach people. If you go get, there's dozens and dozens of credit repair people out here in the city. There's no question at all that you can go to them, and they're going to charge you roughly $100 to $125 a month to repair your credit. Their first line of defense is typically to delete. They're going to go through and, dispute. They're going to go through and dispute everything on your credit report, which is a joke. It's wrong. I mean, if you got a collection on your credit report and it's legitimately your collection, what are you disputing about that? Okay? Number one is we've got to get that dispute off because no lender will close a dispute being on your credit report. So that frustrates us. We've got to get that off of there. But if they're legitimately going to go in and help you remove things that are not correct on your credit report, that's a whole nother animal, okay? Because that's what credit repair is all about, is let's get the junk off your credit report. Let's get the truth onto the credit report. For instance, you might have had a car repo, and you may have taken out a loan on that car for $15,000. It got repoed after 2 years, and they sold the car, but it still shows $13,000 on your credit report. Well, the truth of the matter is it shouldn't show $13,000. It should show more like $1,500 to $2,000 because they sold the vehicle. They got some revenue from selling that vehicle, and that should be the outstanding balance that's showing on your credit report. That's a legitimate, not dispute, but simply calling up the tote-the-note place or the people that you bought the car from and getting it squared away. Sometimes it takes them 3 or 4 phone calls to do that. But yeah, you can get that squared away. Again, I'll coach you through what to do because I want to help you get a loan. So, okay, who's question?
So if I have no credit,
Yes.
so I've never had a credit card, and my husband has great credit, do we have bad credit now?
No, not in the least. We can look at doing it only in your husband's name or question, does your husband have 1 or 2 credit cards that's got some history to them? Okay, become an authorized user on those credit cards. You'll instantly have scores. You'll have scores within 30 days. Okay. Oh, yeah. Excuse me.
I have 2 questions. The first one is about the debt that's on your credit. So say you pay those off. So there's, like you said, you got a car payment on there, and but you paid it off. Does it still stay on there, or just showing the fact that it's paid? Does that help?
Well, anytime anything negative, a collection or derogatory credit that's zeroed out, that's fine. It's no longer affecting your credit scores. Okay, and yes, some things will get deleted off your credit report. Some things will stay on for 7 years. But if it's a zero balance, no issue. It's no issue. The thing a lender is looking at, have you faced up to your obligations and have you satisfied your obligations? Okay, all of us have had some hits along the way. None of us are perfect, but how have you handled that issue? And by it's zeroed out, we as a lender will say, hey, they worked it out. Okay, that's behind them. We're going to look at the rest of the story.
Okay, and getting back to your example about the gentleman who had the $80,000 worth of $250,000 house. What is the rule of thumb when you're looking for the amount of house you can afford versus your income? I was told it's like 3 times your income. That's what you should look for in a house. Total price.
It's really not. That formula really doesn't work. There's a lady over at the far side that wants, and then we'll come back over here. Ma'am, wasn't there? I'll answer your question in just a second. You know, because what happens is that rule of thumb doesn't take into effect what your debts are and what you write off in your tax returns. It used to be a good rule of thumb, but it really doesn't apply anymore. I would just say that if you would do this little formula on your own, if you would figure out what the house payment is, $200,000, 0.9, $1,800, okay? And then you added to that what your car payment is and what your charge card payments are, okay? $400 auto payment and $100 worth of minimum payments on 2 or 3 charge cards. So you got $500 in debt, $1,800 is $2,300. And if you took 45% of your gross income, and that number, that 1,800 plus, that 2,300, 18 plus 500 is 45% or less of your income, you're right there. You're okay. Now, can we expand that? Yes, but on the first salvo, for you just driving down the street trying to figure out, that would be a working formula. The other formula, you're going to get schnookered. That's all. I'm not trying to say no, but you're probably going to miss half the time on that other formula. There was a question over here, ma'am. Sure, just come on up here and we'll talk. Not a problem. Yes, ma'am. Student loans? Yes. Okay. Student loans are something just this past year and a half that we've had to deal with as a debt. And we have to deal with it if the student loans are on your credit report, and if there's no payment on your credit report, then we have to apply 1% of the balance of those student loans. Let's say you got $50,000 in student loans. 1% of that's $500. So we have to take that $500 and put it in your debt ratio. Now, if you have a payment plan on your student loans that's lower than that 1%, but not income-based, because some of the student loan repayment plans are income-based and they fluctuate all the time. We have to qualify people on some fixed student loan program, payment program. We can, if it's a fixed program, we can use then that number if you can get that from the student loan people that you're dealing with. So yes, we just have to apply it to a debt, if you know, as debt, and work it out from there. So it doesn't stop you. But the old days, where if your student loans were deferred, we didn't have to add anything to your debt. Sorry, that went away about 18 months ago. And here's what happened is we got a federal, how do you want to say it, a federal review that student loan debt right now exceeds all other debt in the United States. If you take all student loan debt and add it up, it exceeds all other charge card, auto, and home loan debt in the United States. And so our federal government is facing a huge wall of default in the student loans. So Fannie and Freddie came back and said, we've got to make sure as people are buying houses and their student loans are starting to come due where they've got to start paying on them, that they legitimately have a way of making that payment. And so we don't have a huge home ownership foreclosure, which we had in 2007, because otherwise we're facing exactly what happened to us in 2007, where this huge, you've got this new debt and it's now $500 or $1,000 and you're not prepared for it. Well, what happens first? You don't make your house payment, because there's 2 things you can't get rid of in bankruptcy. There's a whole lot of people that think you can get rid of all your debts in bankruptcy. 2 items you can't get rid of in bankruptcy. IRS debt, you owe the IRS, you'll never be able to discharge any IRS debt through bankruptcy. Secondly, student loans. No federal government debt can be discharged through bankruptcy, and all student loans are now owned or backed by the federal government. So there's a huge misunderstanding that's still existing out there about student loans. You'll go to your grave if you owe taxes or you owe student loans. The other thing, there's a misunderstanding in general credit that I think people sometimes think, well, after so many years it's going to drop off my credit report and it's going to go away and it's never going to be there. If they can verify that debt against you, you could go to your grave with that debt against you, because somebody just has to revive it and reestablish it's against you. And that's a huge misunderstanding, where a lot of people say, well, after 3, 4, 5 years, 7 years, oh, it's gone. Not necessarily. I've seen them be off the credit report for 3, 4, 5 years. I used to have a friend of mine that bought debt, okay, and he would buy $1 million, well, $10 to $15 million worth of debt package every year. He had 2 people on the phone, and they would just work out trying to recollect some of this debt. And at the same token, he would make enough money to pay his people and himself very handsomely during that year. And then he would take what he couldn't do and sell that off for pennies on the market and buy another package for pennies on the market and go at it again. Well, he was a perfect example of somebody that would resurrect a debt and put it back in your credit report. So don't be fooled. That's all I'm trying to say to you. Don't be fooled by people telling you that, oh, for sure. It's not going to happen.